Do you ever wonder why lenders obsess over that 3-digit credit score when you're going to purchase a home? Did you know that a 25-point drop could potentially cost you $50 extra a month when you're going to purchase a property? I'm Jamie Mushaw with Jamie Mushaw Real Estate, and if you're new to our channel, we talk about all things real estate here in Southwest Washington, including Vancouver, Camas, Washougal, Battleground, and other surrounding areas, as well as the Portland metro area. Today we're going to focus on how, why, and what you can do to keep more money in your pocket on a monthly basis when you go to purchase a home solely based off of your credit score. So what is a credit score? A credit score is essentially a snapshot of your borrowing history, including how you've paid the money back that you've borrowed on your credit lines, your credit use ratio, essentially meaning that how much credit are you using versus how much money that you're bringing in on a weekly or monthly basis, the length of history that you've had your credit for, any new credit that you've had, and the credit mix. Credit mix is essentially the different types of credit that you have, credit cards, auto loans, anything along those lines. So a FICO score is your actual credit score, which can range between 350 and 850. And typically mortgage lenders are going to draw the line in different tiers. So you're going to have 620, 640, 680, 700, 720, and most likely 760 and above, which is extremely good credit. Why does credit matter to a lender when you're going to borrow money to purchase a home? Essentially, a higher credit score equals a lower default risk, and when you have that lower default risk, they're typically going to offer you a lower rate when you go to purchase your home, and it also opens up to different potential possibilities for the types of loans that you can apply for. If you're purchasing a property with someone else, essentially what happens is that every applicant on the loan has their credit pulled to see what their credit score is, and if you're buying with that partner, the lower middle score between the two of you is a score that sets the rate when you go to purchase your home. How does credit score essentially drive the interest rate that you have? Again, it goes back to that if you have a higher credit score, you are seen as a lower risk and that you have the high potential of paying that loan back, and it will also give you the opportunity to have those lower rates. So what I'm going to do is put up here on the screen what it kind of looks like if you have a specific credit score and how your monthly payment might look with that credit score. And we're going to base this off of just over a $400,000 loan. If you had a credit score between 760 and 850, you might have an APR of 7.24%. And with a monthly payment of $27.46, between $700 and $759, an APR of 7.45%, which would give you a $28.03 monthly payment. If you had a 680 to 699 score, you would have a 7.56% rate and a payment of $2,832. 640 to 659 score, you would have a 7.71% APR with a $2,875 month per payment. And if you had a 620 to 639 score, you would have a 7.84% APR with a $2,911 a month payment. So you can see as you have a higher credit score versus a lower credit score, there's a significant difference in payment. It could be anywhere from $100 to a couple $100 a month, depending on what price point you're at when you're purchasing your home. Every 20-point drop, it could increase your interest rate by 1/8 of a point for your actual rate. And the other costs that are involved with that is that based off of whatever that credit score is, you could potentially have higher mortgage insurance premiums, or you could have additional discount points added to your loan, which essentially means that you're going to have to bring in more money to close on that particular property that you're looking to purchase. So obviously you want to have the higher rate as possible, so you're avoiding any extra monthly fees added on to whatever higher rate that you're going to have. As I mentioned before, those rates that I was talking about are APR. The APR is going to be your rate, including all of the costs associated with your loan. So now let's put those actual percentages into dollars for a typical loan purchase of like a $400,000 on a 30-year fixed loan with 20% down payment. So if you were at the 620 credit score, you would have a rate of 7.25% with a $2,729 monthly payment, and that's your principal and interest only. If you had a 700 credit score tier, then you would be at a 6.5% rate with a $2,528 monthly payment. If you were 760 plus, you would be at a 5.75% rate with potentially a mortgage of $2,334, so that your difference there is a gap of nearly $400 a month, which is $4,700 a year. That's money that could go towards paying down that actual loan, gaining equity into the property, or maybe you're wanting to use that extra $4,700 to actually upgrade the property or put it away into savings or any type of retirement that you might have. Additionally, with that rate difference, you have to think about the life of the loan. So the life of the loan on a $400,000 property that you're looking to purchase, that would roughly equate to you paying $630,000 if you were at that 7.25% interest rate because you had a 620 credit score, versus if you had that 760 plus credit score, then you're roughly paying about $551,000 for the total cost of the purchase of that property over the life of the loan. That's almost $80,000 that you could be saving just by having a bit of a higher credit score. What are some quick wins that you can do to lift your credit score as you're looking to purchase a home? One of the most important things, if not the most important thing, is pay on time every single time. Your payment history is about 35% weighted of your credit score. You want to shrink down your balances below 30% because the utilization of your credit is an additional 30% of what your credit score is. You want to avoid any new credit lines or having your credit inquired on leading up to purchasing home. That means that you don't necessarily want to open any new credit cards or try to purchase a new car, because that's going to bring your credit score down when they do those hard checks on your credit as you're trying to purchase a property. Additionally, don't close any old accounts, because those old accounts is going to show your payment history, and the longer payment history that you have, the better off you are to get that lower rate when you're looking to purchase a property. Lastly, you want to check your credit report and look for any errors that are on that report, because you want to be able to dispute any mistakes as soon as you can, because that will bring your credit score up if there are any errors on your credit report. So when should you start working on your credit? You should start working on your credit about 6 to 12 months prior to starting your house hunting. And the real reason for that is because that's going to give you enough time that if you, in fact, that you might have to open some new credit to bring your score up, that's going to allow you to get that payment history going, and it's not going to be in that window of a couple months prior to purchasing a property that will no longer look like a hard pull on your credit. And even small bumps in your credit score from 675 to 705 could have a substantial difference in whatever your monthly payment is going to be when you go to purchase your home. Also, FHA and VA loans welcome scores down to 580, sometimes lower, but expect higher rates and higher mortgage insurance if you are down in that lower end of your credit score. Ultimately, at the end of the day, you want to try to get up into that higher score so you could potentially get a conventional loan, because if you're getting a conventional loan, typically your rates are going to be lower, number one, and your mortgage insurance is going to be lower as well. If you're putting 20% down, then you're not even going to have mortgage insurance anyway. Your credit score is not just a number. It's your purchasing power when you're looking to buy a home. You want to protect it, you want to polish it, and you want to pay it back when you're borrowing from it. If you have any questions about how to raise your credit score, feel free to leave a comment down below or shoot me a message. If you like this video, please like and subscribe. Additionally, we have a link down in the comments to our free weekly newsletter. And we have other great videos coming up here in the future. I'm Jamie Mushaw with Jamie Mushaw Real Estate. Thanks for watching our video.